The Intelligent Investor by Benjamin Graham is considered as the investment Bible of successful investors and business stalwarts like Warren Buffett. Published in 1949, the first edition of the book has taught millions of people how to become adept at managing their investments. The eye-opening insights about the stock market and investor behaviors have helped millions of investors learn the ropes and become better and more responsible investors. This book protects investors for themselves and their tendencies. Important theories, principles, and concepts are explained with real-life examples, making them easier to understand and visualize by the lay investor. Chapter 1 distinguishes investment from speculation and presents the kind of results the intelligent investor should expect. Chapter 2 explains in detail the relationship between investors and inflation and how the latter can affect the investment decision-making. Chapter 3 provides an overview of the history of the stock market and shows the level of prices in 1972. Chapter 4 to 8 profiles the types of investors and their behaviors and attitudes about investing. Chapters 9 to 11 shows how investment fund works and how security analysis is done. Chapters 12 to 18 presents case histories, comparative analysis, and stock selection. Chapter 19 emphasizes the role of shareholders and management and explains how dividend policy is crucial to investment. Chapter 20 explains the importance of margin of safety in investing. It is the hope of this book that readers can benefit from the wisdom and incredible insights of the greatest practical investment thinker that ever lived. Investing in stock market is a risky behavior. No matter how exciting some investment prospects are, they don't guarantee profitability. This book shows that there are ways to minimize the risks and ultimately maximize the gains. It is hoped that readers would feel enlightened by the richness of the information in this book and start to alter their wrong views about investing in the stock market. The Intelligent Investor does not only provide a sound and analytical tool for investing, but it also provides an emotional framework essential to developing the right kind of discipline and attitude towards investing in general and the stock market in particular. It prepares the investor for the volatile nature of the stock market so that they would behave and react to highs and lows responsibly. Stock selection can be a long and tedious process if you want to do it right. Even with careful examination, constant monitoring, and in-depth analysis, there's no guarantee that the chosen stocks would provide the expected returns. Without the necessary analytical tools and the temperament to deal with the unpredictability of the market, it will be impossible to emerge victorious in the investing game. This book can help ordinary investors transform into extraordinary ones by following Graham's recommended approaches and strategies. Investors can benefit tremendously by learning from Graham's vast experience and knowledge of the stock market. Graham combined his intellectual powers, solid experience, and common sense to put together a guide that will stand the test of time. Investment versus speculation. Results to be expected by the intelligent investor. To distinguish an investor from a speculator, it's important to define investment and speculation. In an investment operation, the principle is promised safety and sufficient return on investment. Processes that do not meet these two requirements are considered speculative. This was the standard definition strictly followed since 1934. In the Wall Street lingo, anyone who trades in security has become an investor regardless of what was bought or sold and for what purpose. Common stock purchases in general were regarded as highly speculative and carried a level of risk when sold on a most attractive basis. Given the radical changes that occurred over the years in the realm of stock market investing, Wall Street, as a financial institution, should reinstate the distinction between investment and speculation. Otherwise, the stock exchange will be blamed for the heavy losses brought on by speculation. An informed investor will recognize the speculative factor in his own common stock holdings. Investors should also limit this type of holdings to the minimum and be mentally and financially prepared for any adverse results from such investments. Although speculation is riskier because of the uncertainty it carries with it, some speculations are unavoidable and even necessary. Investors should then avoid unintelligent speculations that could lead to huge losses. They should not treat speculation seriously if they do not have the sufficient skill and knowledge to engage in it. Sometimes in speculation, people risk more money than they can afford to lose. Brokers have a duty to advise investors that when non-professionals operate on margin, they are essentially speculating. In addition, those who buy a hot common stock issue is gambling and therefore speculating. Since the gambling element of speculation is attractive to some people, a stop-loss measure is to set aside a small portion of the capital for that purpose and make sure they are separate from investment operations. A defensive investor is someone who's interested mainly in the safety of his investments and values the freedom to do it without being bothered. The results from investment can be expected provided that normal conditions exist. In 1965, it was recommended that the investor divides his investment between reputable common stocks and high-grade bonds. The ideal proportion is 50-50 between the two, with room for adjustment. Should there be market disturbance or development of 5%, bonds should not be less than 25% and not more than 75% alternatively. The common stock portion can be reduced to 25%. If the market was on a dangerous level, on the other hand, if the stock prices go into free fall, it can be increased to 75%. Investors could get 4.5% on high-grade taxable bonds and 3.25% on good tax-free bonds. The dividend return on leading common stocks was 3.2%. Under normal market price and condition, the 50-50 division can yield about 6%. This was considered a satisfactory result for that period in 1964. Assuming there were no significant upward or downward movement in the future, the defensive investor should be able to rely on the 3.5% dividend yield from his stocks and also on the 4% estimated yearly appreciation, which was due to other companies' reinvestment. Looking at it on a before-tax basis, the combined returns of stock would have an average rate of 7.5%, 5.3% after tax. Although satisfactory, this was less than the interest on high-grade bonds. Good bond investments were preferable to stock investment because of their good performance, but largely because the interest of the principal payments are guaranteed, therefore are better protected against uncertainty and fluctuations. A defensive investor would change how he divides his funds between stock and bond components based on the information he has on interest and market changes in the current time period, making sure that he leans towards the conservative side and not on the speculative information. The aggressive investor, on the other hand, desires to get better yield and better overall results compared to his risk-averse counterpart. At the same time, he wants to make sure that his results will not come out worse than his peers. Interestingly, investors and speculators generally obtain better than average results by doing essentially the same things. They trade in the market by selecting stocks that behave better than the market average. They capitalize on short-term selectivity, in that they buy stocks from companies that report or are expected to report increased earnings, or if they were anticipated favorable developments. They also go for long-term selectivity, in that they monitor the growth records of companies and invest in those that showed excellent records for a long stretch of time. Companies that have no records to show yet, but are expected to establish high earnings later on, are likely to be selected as well. For example, electronics, drugs, and computers. Essentially, there will always be golden opportunities for investors to get better than average results. As a rule of thumb, marketable securities should yield satisfactory results and should perform better than the DGIA average or any similar weighted index. Commentary in Chapter 1. Graham's definition of investing was as clear as day. By choosing to speculate, you decrease your chance of accumulating wealth. The conservative way is to analyze a company and determine if it will be a sound investment based on its underlying businesses. The investor should be deliberate about wanting to protect himself against heavy losses. That is why it is important to aspire for results that are adequate, not for an extraordinary performance that's not sustainable in the long run. Graham urges you as an investor to invest based on your comfort level. That is, you're comfortable with owning a stock even if you don't monitor the daily share price. Speculating, though exciting and sometimes rewarding, does not put you in a comfortable level because it's similar to gambling in casinos. The odds are stacked against you because Wall Street and other exchanges have calibrated the odds to their favor. Just like gambling, no one can beat the house at its own speculative game. Investing, on the other hand, is a different kind of game, where you stand to win in the end as long as you play by the rules. Put simply, investors make money to build up their wealth, while speculators make money for their brokers. This is why Wall Street prefers people playing speculative game. The investor and inflation. Inflation has been considered a public enemy because it shrinks the purchasing power of the dollar. Those with fixed dollar incomes are greatly affected by the rising inflation consequently. lowering their living standards. Stockholders, on the other hand, have the opportunity to offset the loss of the dollar's purchasing power through the advances in their share prices and in their dividends. Based on these facts, it was concluded by several financial authorities that common stocks are inherently more desirable than bonds as a form of investment. This is contrary to what was previously stated by bonds. This is contrary to what was previously stated that bonds are better because they're fully guaranteed, in order to come up with a convincing conclusion regarding the extent to which investors may be influenced by expectations on a future increase in price level. Various measurements to the inflation factor must be applied. Can investors do better by buying and holding other investments other than bonds? Common stocks have fared better against bonds over a significant period of time. An 8% per annum return is substantially better than the rates from bonds over a 55-year period from 1915 to 1945. However, the reality is that although common stocks may do better in the future, there's no certainty that they will do so. For some investors, the volatility of the stock market and the ever-fluctuating nature of inflation pose a risk that makes them uncomfortable in investing in stocks. Fortunately, there are alternatives to common stocks. Investors are in a precarious situation when they cannot protect themselves against inflation by putting their money in valuable objects like diamonds, rare coins, paintings, and first edition books. Real estate ownership has been considered one of the more robust long-term investments because it has a built-in protection against inflation. However, it does not come with some form of risks. Real estate values also experience wide fluctuations. There is always the risk of serious errors in pricing. Under normal conditions, real estate is a sound investment vehicle if the stock market is too unpredictable. Another alternative is diversification, but this is reserved for investors with money to burn. For investors with modern means, it may not be the best option. Investors should not put all their funds in one basket, even if one investment offered unprecedented high returns. It's always better to go the conservative route and seek to minimize risks and maximize profits. Commentary on Chapter 2. There's a tendency for investors to overlook the importance of inflation. Investors should measure their investing success or prowess not on how much they made, but by how much they were able to keep after inflation. Inflation can paralyze an economy by increasing the prices of goods. It makes exports expensive. American goods cannot compete in the international market if the prices are not competitive. But most of all, inflation is the destruction of wealth. It eats up the value of holdings and significantly diminishes everyone's purchasing power. It's not entirely true that buying stocks can help investors guard themselves against the adverse effects of inflation. Data from 1926 to 2002 gives a snapshot of the relationship between stock prices and inflation. When the prices of goods and services took a dip, the stock prices also fell, with the market losing more than 43% of its value. Interestingly, when inflation soared above 6%, the stock also performed badly. In fact, the average return was only 2.6% in the years where the inflation went beyond the 6% rate. What this means is that the moderate inflation passed the costs on to their customers. It's with high inflation that creates a dent in the consumer purchasing power that consequently forces consumers to cut their purchases. Graham introduced two inflation-fighting investment vehicles that could bolster your defenses against inflation. The first one is the REIT, or Real Estate Investment Trust. These are companies that own commercial and residential properties and collect rent from them. The second inflation fighter is TIPS. This is the Treasury Inflation Protected Securities, which is a type of U.S. government bond that increases in value in the event inflation increases. In a nutshell, TIPS protect you not only from financial loss, but also from the loss of purchasing power. TIPS by nature are volatile in the short run, but they stabilize in the long run. So, the best way to utilize TIPS is to allocate about 10% of your retirement assets to TIPS. It keeps that portion of your money safe and sound from future inflationary threats. A century of stock market history. The level of stock prices in early 1972. A smart investor would have adequate information about the stock he plans on investing in before making any decision. This is a good start, but every investor should also have knowledge of the history of the stock market itself. Learning the history will allow you to see trends and patterns in the movement of stocks as a whole. This is important to know and to study. to get a snapshot of the varying relationships between stock prices and their earnings and dividends. It allows investors to be prepared to act when the market behaves outside of the norm. Historically, the stock market has depicted various market fluctuations brought on by world events. Highs will be followed by lows, and it becomes a cycle. The only difference is that we do not know how much the stock market would increase or decrease. Sometimes the market makes a fast recovery, while other times it crawls. In order to get a much more accurate picture of how the stock market performed, the analysis of price movements should be supplemented by data on earnings and dividends. Studying the stock market history will give investors awareness about the variables that affect the performance of the market. No one can be truly prepared for a sudden world event that could send prices plummeting, but knowing the historical movements of the stock market will give you an idea of how devastating it could be to investments. It just makes you better informed to make critical decisions that could minimize your risks and losses. Essentially, investors should always choose the path of caution when it comes to investing in stock market. It's important to follow some investment principles that were set out under the 1964 conditions. Investors should not resort to borrowing funds to buy or hold securities. Investors should not increase the portion of the funds allocated to common stocks due to the volatile nature of stocks. Investors should bring down their common stock holdings to a maximum of 50% of the total investment portfolio. They are better off investing in high-quality bonds or just put the money in the bank as a savings deposit. Commentary in Chapter 3. The main takeaway in this chapter is that investors should study and analyze the historical performance of the stock market to get a feel of how the market works and behaves in general. However, it must not be used to make forecasts. This is because there are many outside events that could easily trigger a rise or a fall in stock market prices. Investors should not expect past levels to happen in the future. There's too much uncertainty and volatility that it would be unwise to be bullish about investing based on past markets. There's a tendency to go overboard with conclusions because there's the assumption that the same trends and patterns will repeat itself in the future. It may or may not happen, but no investor should gamble their money away based on what is essentially just a hunch. Some so-called market gurus went so far as to say that since stocks have always beaten the bonds in the last 30 years, then stocks are less risky than bonds or even cash deposits in the bank. Graham calls this as an example of bull market baloney. There are no absolutes in a market that are so sensitive to outside forces. The fatal error of investing gurus was that they ignored important data and just focused on the data that portrayed the stock market as bullish. Another important thing to consider is that stock indexes ignore the companies that went bankrupt in the early years, a concept known as survivorship bias. As a result, these stock indexes overstate the results earned by investors. Sure, there are companies that continuously prospered, but for every survivor, there were thousands of companies that did not survive the financial disasters. Not many investors are aware of this because these dead stocks were completely quashed from the historical stock indexes. To avoid the investment pitfalls, investors should remember that the stock market's performance is affected by three factors: real growth, inflationary growth, and speculative growth. An investor can make an informed decision if they're able to drown out the hype, and just be aware of how these three factors play out. General portfolio policy: the defensive investor. An investment portfolio is generally determined by the owner's position and characteristics. In the past, their investments were limited by law to only a handful of investment instruments like high-grade bonds and preferred stocks. More experienced investors include just about any kind of stock or bond in the securities list as long as they perceive it as an attractive purchase. Then, the conservative ground was to invest based on the degree of risk the investor was ready to take. However, according to Graham, it should be based on the effort the investor is willing to bring to bear on his investment goals. Passive investors who want to be safe will likely get a minimum return on investment, but investors who use all the information they have at their disposal can stand to get a maximum return. The oversimplified 50-50 formula makes good sense for the defensive investor. Apart from being extremely simple, it restrains the investor from investing more heavily in common stocks. This conservative approach will get satisfactory results during a rising market. In a declining market, the defensive investor will emerge better off than his risk-taking friends. For bonds, U.S. savings bond remains a sensible purchase for investors because they're safe and they give a high return than other first-quality bond instruments. This is especially true for investors with moderate means, say $10,000. For investors with higher capital, other types of bonds are much more desirable. Other options in lieu of bonds include savings deposit, convertible issues, call provisions, and non-convertible preferred stocks. Commentary on Chapter 4. How aggressive your investment portfolio is depends on the kind of investor you are. You must strive to become an intelligent investor in order to get the maximum results from your investment. To be an intelligent investor means to continually research and monitor dynamic mix of stocks, bonds, or mutual funds. The other option is to create a permanent portfolio that does not require further effort to research and monitor. Graham recommends a 50-50 split between stocks and bonds because it prevents investors from acting recklessly when the market becomes dangerously high. The first option takes a lot of time and energy, but this approach detaches you from the emotional pitfalls of a bullish market. The second option is reserved for the defensive investor. You can be successful with either of these approaches. Takeaway from this chapter is that financial risk does not only lie in the economy or investments, but also within ourselves. So our investment choices are influenced by our own attitudes towards risks, our financial capabilities, and our current economic situation. The defensive investor and common stocks. In general, common stocks are viewed as a speculative and unsafe investment. Back in 1949, common stocks offered some degree of protection against inflation, unlike bonds that don't offer protection at all. Another advantage was that the common stocks provided a higher average return over the years through dividends and the increase in market value. Graham devised 4 rules for the common stock component. Number 1, diversification should be adequate. A minimum of 10 and a maximum of 30 issues. Number 2, companies must be large and conservatively financed. Number 3, companies must have a record of continuous dividend payments. As a side note, all issues in the DGIA have met the dividend requirement since 1971. Number 4, there should be a limit on the price to pay for an issue in relation to its average earnings over a period of time. As a rule of thumb, it should be set at 25 times such average earnings for the past 7 years. It should not go beyond 20 times its average earnings for the last 12 months. Investors are required to submit their security lists for periodic inspection by investment counselors. This is now a standard practice to ensure that the quality of the portfolio can be improved. If after inspection the securities are not performing as expected, then a portfolio change can be done. Commentary in Chapter 5. When the stock market crashed in 2000 to 2002, many investors viewed stocks as too risky for comfort, and that it would be best to stay away from them. However, that was not the case. This is because the very act of crashing took much of the risk out of investing in the market. When the prices fell, the securities became reasonably priced. If they can lead to future growth, then it's sensible to own them regardless of losses incurred in the recent past. As an investor, you must have a deeper insight and an understanding of the securities you pick. This can be done by studying their financial statements, estimating their business value, and monitoring their performance. If you have this higher level of understanding of a stock, you get a deep sense of what's good and bad. It's not just simply buying Amazon stocks or Starbucks stocks because you use their services. It takes a lot of research and monitoring, but you'll find that such a practice pays off in a big way. Unfortunately, most investors ignore this part and just leave everything to chance. Portfolio policy for the enterprising investor. Negative approach. Both the defensive and aggressive investor start by dividing their investment funds between high-yield bonds and common stocks. But that's where the similarity ends. This is because there's no single pattern for the aggressive approach to investing. It would still depend on not only the investor's competence and tools, but also on his preferences and interests. A general practice is to leave the high-grade preferred stocks to corporate buyers and avoid inferior types of bonds and preferred stocks. Investors tend to shy away from foreign-issued bonds. The aggressive investor, on the other hand, would find himself using the opposite approach. As for new issues, investors must be wary of them, but they shouldn't completely ignore them. New issues should be subjected to critical examination and testing before they're purchased, because by their very nature, they are untested and risky. Research and examinations of securities become more important as investors move from the highest quality bonds to second-grade issues to common stock flotations. Whatever the case, the basic requirement for any intelligent investor is to resist salesmen offering new common stock issues during bull markets. This is because speculative behavior is at a high during these times. However, these issues may prove to be excellent buys a few years down the line, which could be a time when nobody wants them and can be purchased at a fraction of their true value. Commentary in Chapter 6. What you do as an investor is as important as what you don't do. Graham warned of investing in second-grade or lower-grade junk bonds because they're just costly and burdensome to diversify the risk of default. Ironically, over 130 mutual funds specialize in these so-called junk bonds. But the case is a little different because these funds buy junk bonds by the truckload, so it mitigates the complaints in diversifying. Since 1978, 4.4% of the junk bond markets has gone into default. Despite this, bonds have still managed to yield an annual return of 10.5%, which is better than the 8.6% produced by the 10-year U.S. Treasury bonds. This may be impressive, but keep in mind that most of these junk bonds charge high fees and they don't do a good job of preserving the principal amount of the investment. What this means is that a junk bond fund can be a minor option and not a requirement to add to any intelligent investor's portfolio. Portfolio policy for the enterprising investor, the positive side. The goal of the enterprising investor is to obtain a better investment yield. He will devote a good amount of the time and energy to ensure that he will get the best results he could possibly have. Apart from high-quality common stocks and high-yield bonds, an enterprising investor might be keen on investing in the following. 1. Tax-free, new housing authority guaranteed by the U.S. government. 2. Taxable high-yield, new community bonds guaranteed by the U.S. government. 3. Tax-free, municipality-issued industrial bonds serviced by lease payment from strong corporations. The enterprising investor can engage in the following activities. 1. Buying in low markets and selling in high markets. 2. Buying growth stocks, which are carefully studied and evaluated. 3. Buying bargain issues. 4. Buying into special opportunities mentioned above. The growth stock generally performs better than the market average over a period of time. Logically, since the growth stock provides better results, the intelligent investor should focus on selecting the best growth stocks. However, it's more complicated than that because stock with excellent track record sell at high prices, so they may not fare well because the investor has paid full price for the expected yield. Investors should also take the rapid growth as an investing caveat because it cannot be sustained forever. Once a company records an impressive expansion, it will be difficult to replicate its achievement. After growth flattens out, it can go downward. The appeal of larger companies is twofold. First, they have resources and brainpower to survive adverse situations. Should they stumble and lose a fraction of their value, they can recover and get back to satisfactory earnings. This is best demonstrated by the companies listed in the DGIA. Commentary in Chapter 7. Ideally, the intelligent investor would buy stocks when they are reasonably priced and sell them when they become overpriced. They would repeat the process when the stocks become cheap again. However, the problem here is timing. How can an investor determine the right time to buy stocks and when it is best and when it is the best time to unload? The answer is no one really knows. Don't be fooled into thinking that you can decide with absolute certainty in real time when to load and unload. Foresight is legally blind, and market timing is impossible to foresee. Andrew Carnegie said that investors should put all their eggs into one basket and then watch the basket. Graham agreed with this and pointed out that the real big fortunes that came from investing in common stocks are as a result of people putting all their funds in one investment that they knew so well. This is why most of the richest people in the US amass their wealth by concentrating their investment in one single industry or company. Examples would be Microsoft, Walmart, and Standard Oil. Although this is the case for massive companies, not many fortunes have been kept that way. Carnegie neglected to mention that concentration of investment also creates failures. In fact, only 64 of the original Forbes 400 members from 1982 remained on the list in 2002. What this shows is that the ever-changing economic landscape and the emergence of booming industries can crush investments that are concentrated on just one thing. The investor and market fluctuations. Investors who put their funds in high-grade bonds with a short maturity of 7 years or less will relatively not be affected by significant fluctuations in market prices. However, longer-term bonds and common stocks portfolio are almost certain to fluctuate at any given period in a span of several years. Fluctuations happen and investors should be financially and psychologically ready to face the consequences. With keen awareness of how the market behaves, an investor can actually take advantage of fluctuations by buying or selling stocks at favorable prices. This is a legitimate behavior, although it falls under speculation. There's nothing evil about this, but investors must be reminded that if they want to speculate, then they have to accept the possibility of losing money while they engage in such activity. They should limit the risks by separating the fund for it from their core investment portfolio. Timing and pricing are two key elements every investor needs to consider if they want to profit from the pendulum swings. With timing, it's necessary to anticipate the behavior of the market. That is, buy or hold on to a stock if the market is on an upward trajectory and sell if the market is down. With pricing, the investor must endeavor to purchase stocks when they're below their fair value and sell if they're above their fair value. If the prices don't go below the fair value, the investor could still buy stocks, but it should be at advantageous prices and not too expensive. Commentary in Chapter 8. The market is considered to be accurate in pricing the stocks. Buyers and sellers in the market do a pretty good job of haggling over prices to get a fair value. However, the market is not always right. Sometimes the market does a lousy job at pricing stocks. Mr. Market, as Graham called the manic depressive market, does not act as an appraiser would. Instead, Mr. Market pays a lot more than the stock's objective value when stocks are aggressively strong. Conversely, Mr. Market could not wait to dump the stocks for less than their value when they are down. Depending on Mr. Market's mood, a company's stock price could plummet, even if it's profitable. Worse, Mr. Market could overvalue the stock price even when the company is not profitable. As an investor, you should know better than to let a lunatic tell you how to feel about stocks and their prices. Always proceed with caution and resist the urge to cash in when Mr. Market is feeling a little too excited about stocks. Mr. Market's job is to present you with the prices, and it's your job to decide if the prices are advantageous to your ultimate purpose. Investing in investment funds. One course that's available to the defensive investor is to put money into investment company shares. An example of this is mutual funds, which are redeemable on demand at net asset value. Mutual funds are open-end funds, which means that additional shares can be purchased. Non-redeemable, closed-end funds have shares that remain constant. There is a smorgasbord of funds that are being offered to investors. They consist of different components of bonds or stocks, and the varieties like bond funds, hedge funds, letter stock funds, etc. There are those that are classified by their objectives or main aims like capital appreciation or price stability. Companies who focus on capital gains purchase growth stocks. Others specialize in specific areas like chemicals, aviation, or foreign investments. As a whole, the performance of the fund industry has served its purpose. They encouraged a good investment habit and protected many less informed individuals from the very costly mistakes in the stock market. In general, those who put their money exclusively in investment fund shares in the last 10 years or so have fared relatively better than those who made direct common stock purchases. There are special risks involved in investing in mutual funds, but based on the performance of mutual funds over the years, large funds, if managed well, can produce only slightly better than average results. If not managed soundly, it can produce spectacular profits for a while, but they would be followed by even more disastrous results. Commentary on Chapter 9. Mutual funds were introduced in 1924. They're quite attractive to investors because they are relatively cheap, highly diversified, convenient, professionally managed, and tightly regulated. However, despite the huge advantages, mutual funds are not perfect. Because of the imperfections, many of the funds tend to underperform, cause tax problems, overcharge investors, and suffer erratic swings. It's just human nature to believe that funds that go up fast will continue to do so in the long run. If the fund is consistently beating the market at its game, we have the tendency to think that it will keep outperforming the market. Unfortunately, our intuition is not always right. When it comes to the financial markets, there are no guarantees. We are constantly reminded that buying funds based on past performance is stupid. Financial scholars who have been studying mutual fund performance agreed on the following points. The average mutual fund does not pick stocks that could overcome the cost of research and trading them. Higher expenses incurred from investing in a fund means lower returns. The more frequently a fund trades, the less it tends to earn a profit. Highly volatile mutual funds that fluctuate more than the average are highly likely to stay that way. Funds that produced excellent returns in the past are unlikely to sustain their winning streak. Mutual funds can offer great returns, even if it doesn't beat the market, because you are given an economical and easy way to diversify your holdings. It also does not give you the burden of picking your own stocks. The investor and his advisors. Many investors are amateurs at investing. As such, it's just natural to feel the need for some guidance from financial advisors. The role of the advisor is to use his skills, intellect, and training to protect his clients from making terrible mistakes and ensure that they achieve the results that can be expected from the money invested. It's when the client begins to demand more gains than the average return on his money that the role of the advisor becomes a blur. This is essentially asking the advisor something that he's probably unlikely to deliver. As a word of caution, if the investor relies chiefly on the advice of other people on how to handle his money, then the best route would be to engage in conservative forms of investment. If the investor becomes highly knowledgeable about the stocks and the market as a result of having an advisor, then he can very well be competent enough to pass judgment on his own. He then needs to transform from a defensive and enterprising investor into an aggressive and enterprising investor. Commentary in Chapter 10. In the late 1990s, many investors chose to do things on their own. They do their own research, pick their own stocks, and place their trades via online brokers. Suffice it to say, they bypassed the expensive infrastructure of research, advice, and trading of Wall Street. When the market crashed, they felt stupid for doing it alone because they experienced massive losses. The truth is that those who benefited from an advisor lost some money too. Oftentimes, investors could benefit from an outsider's view of the market. They need more reliable information that could help them to achieve their financial goals. There's really no shame in seeking professional help in managing your investments. An advisor worth keeping would have a system in place to protect you from investment mishaps. He would help you devise a comprehensive financial plan, an investment policy statement, an asset allocation plan. These are the building blocks on which sound financial decisions are made. Security analysis for the lay investor. General approach. Financial analysis is a legitimate and well-established profession that's continually flourishing. Security analysis and financial analysis are used interchangeably, but the latter has a wider implication and is better suited to describe the work of Wall Street senior analysts. Security analysis is limited to the examination and evaluation of stocks and bonds, while financial analysis includes investment policy analysis, portfolio selection, and general economic analysis. The security analyst deals with the security issues in that he summarizes the operating results and financial position of stocks, identifies the strong and weak points, and makes the best guess on the future earning power of specific securities. He determines whether the attractiveness of stocks have a sound basis. He essentially scrutinizes stocks using financial analysis techniques. Lay investors may have trouble understanding the more complex side of the analysis being presented by the security analyst. However, an investor looking to put his money on stocks should at least have a working knowledge of the analysis process. Common stocks analysis is a process that evaluates the price of a stock, which can determine the attractiveness of that stock. The evaluation is done using a standard procedure for estimating the future earning power of stocks. Commentary on Chapter 11. By using conventional methods of valuation, investors are able to determine if a stock is worth purchasing. However, there are other elements at play that should be factored in when deciding on the stock to buy. Long-term prospects of the company, the quality of the company's management, the company's capital structure and financial strength, current dividend rate, and historical dividend record. When these elements are analyzed together with the financials, the investor can get a clearer picture of the company's overall health. Things to consider about per share earnings. Graham offers two important pieces of advice to investors. 1. A single year's earnings of the company should not be taken seriously. And 2. If you take short-term earnings seriously, look out for the traps in the per share figures. Even seasoned investors will find that corporate accounting can be tricky and security analysis can get too complicated. So data and information should not be taken at face value. There are hidden meanings in financial statements, and investors should pay close attention to the footnotes and exceptional cases to get true information about the company. Over the years, analysts have used average earnings to help iron out the fluctuations brought on by the business cycle. It's perceived to be a better approach to give a better idea of the company's earning power than results for 1 year. If average per share figures are used in conjunction with the growth numbers for the same period, investors can get a much solid information about a company's past performance. Commentary in Chapter 12. Investing is generally a numbers game. Company executives who are heavily compensated by stock options know that they could profit from the company's increased earnings. This is why accounting principles are violated and financial reports overstate profitability. Companies and their accountants carry out questionable practices and push the limits of propriety to make profit figures desirable. One notorious practice is the use of pro forma earning. The original intent was to give a truer picture of the long-term growth by making adjustments in short-term non-recurring events. However, this was abused in the 1990s when companies started disclosing inflated pro forma earnings as if they were not paying dividends or payroll taxes. Losses and charges were downplayed and sometimes hidden so that the companies look solid on paper. Investors are advised to ignore them because they don't tell the real story of the company's real financial performance. A comparison of 4 listed companies. This chapter shows security analysis at work using 4 companies listed on the New York Stock Exchange market. They are Altra Corp, Emerson Electric Co., Emery Air Freight, and Emhart Corp. They're chosen successively from the NYSE list, so even if they have similarities, their differences are more significant. The companies are analyzed based on their profitability, stability, growth, financial position, dividends, and price history. Based on the analysis, the earnings ratio of the 4 companies vary more widely than their operating performance. Given the randomness with which they were chosen, glaring differences in performance were not surprising. Emerson and Emery were more appealing to investors because of their recent earnings, growth, and market action. However, the two reasons go against the principles of conservative investment and therefore should not be valid for selection. In contrast, Altucher and Emhart have sufficient values that constitute satisfactory protected investment. In summary, the requirements for defensive investing are 1. Sufficient size. 2. Strong and sufficient financial condition. 3. Consistent dividend payout for at least 20 years. 4. Absence of earnings deficit in the past 10 years. 5. 10-year growth of per share earnings. 6. Stock price of no more than 1.5 times of the company's net asset value. 7. Stock price of 15 times average earnings for the past 3 years. Commentary in Chapter 13. Graham has always warned people about emotional investing. But more than that, he warned that investors are too caught up with anticipating the future of stocks, that they are already paying for it well in advance. They tend to overdo it in anticipation of a financial windfall that may never come. They put too much time and effort in projections and predictions without regard for the possibility that they could face huge, permanent financial loss. Stock selection for the defensive investor. Cautious investors will buy high-grade bonds and a diversified list of common stocks at a justifiable price. To set up this diversified portfolio, he can choose to go the DGIA route, wherein he buys stocks that represent a cross-section sample of the leading stocks of the market. This is a great combination of highly favored growth stocks and less popular ones. The second option will be to select stocks based on the standard practice, as suggested in Chapter 13. Every investor wants his list of stocks to perform better than the average, whether he hires a competent advisor or does the picking himself. After all, an advisor should not be expected to guarantee a superior investment package. An informed investor should be able to use his skills to apply investment techniques to significantly improve his holdings. Graham has emphasized that the current price of a stock reflects known facts as well as future expectations about them. These are the two bases for which market valuations are arrived at. The future can be approached in two different ways: prediction and protection. Investors who favor prediction will aim to anticipate what the company will achieve in future years, whether or not the company will show persistent growth, using metrics like volume, price, and cost. The investor can make a projection of future growth based on past statistics. In contrast, investors who favor protection will always be concerned about the price of the stocks. What's important to them is that they are assured that the present value is always above the market price. Commentary in Chapter 14. Going by Graham's suggestion, defensive investors can simply buy stocks listed in the Dow Jones Industrial Average. However, they can do much better with all the tools available to them. For low-maintenance stock investing, it is suggested to invest in low-cost index fund consisting of stocks that are deemed worth having. Stock picking from scratch involves a lot of research and close monitoring, and is definitely not for everyone. One way to make investing a little less difficult is to use the index fund as a foundation of your future portfolio. It's much easier to experiment around stocks if there is already a baseline to start with. With 90% of the funds apportioned to index, you are free to play around with the remaining 10% for stock picking. Having a solid and diversified index fund is key to long-term gains. Stock selection for the enterprising investor. The enterprising investor focuses on making individual selection of stocks that are likely to be more profitable than the average stock. It requires no special ability to select stocks that would give average results. Investing in the Dow Jones Index Fund would give an average return. It's extremely difficult to get more substantial results, as evidenced by the records of investment funds over the years. Since price movements are random, even analysts are faced with the impossible task of predicting the unpredictable. The chapter introduces the Graham-Newman methods that made use of the arbitrages, liquidations, related hedges, and bargain issues to get better than average results. Results were monitored for each class of operation. As a result, Methods that do not give satisfactory results were discontinued. In their case, it was the purchase of attractive issues and unrelated hedging operations. In 1939, the effective methods were self-liquidating situations related to hedges and working capital bargains. Obviously, this would not be profitable at all times, so the enterprising investors should be able to figure out the right approach. In general, they might be compelled to limit their selection to industries and companies they're optimistic about. This is risky because it involves paying high prices for stocks. Following the Graham investment philosophy, the enterprising investors would most likely buy cyclical enterprises. For example, steel. When the situation is unfavorable and the price is low, which reflects the current pessimism about the stock. Commentary in Chapter 15. There's more than one way to get profitable results from stock investing. What works for one investor may not work for others. Leading fund managers use different techniques to maximize their gains and minimize their risks. Investors are reminded that choosing individual stocks is not advisable when there's a presence of index funds handpicked by seasoned stock market professionals. However, this does not mean that picking your own stocks is not going to be profitable. Graham has advised spending a year tracking and picking stocks. This hypothetical buying and selling provides the investors with lots of practice that can help increase the likelihood of success. Test driving the techniques can help you develop the discipline to avoid acting based on emotions and hunches. After selecting a hypothetical list of stocks, compare the results against indices like the Standard and Poor's 500 Index Fund to determine if your stock picks are far better than the index. If they're not better than the index, then you're better off investing in funds than picking your own stocks. Convertible issues and warrants. In recent years, convertible bonds and preferred stocks have been taking center stage in the realm of senior financing. Repeatedly, stock option warrants, which are long-term rights to purchase common shares at a stipulated price, have become popular among investors. Between convertible issues and warrants, the former ranks higher. Convertible issues are believed to be beneficial to both issuing company and investor. For one, the investor gets the protection of a bond or a preferred stock while having the chance to participate in any significant increase in the common stock's value. In turn, the company is able to raise capital at a moderate interest or dividend cost. It would seem a win-win situation, but it doesn't mean there are no risks involved. The problem arises when investors get a little too enthusiastic about the company's prospects and the share's favorable market action that they convert their holdings prematurely, thereby losing their claim to interest plus a bitter profit. Commentary in Chapter 16. Convertible bonds behave like stocks, but work like options. Holding a convertible automatically makes you a holder of an option. You can hold onto the bond so it keeps earning interest, or you can exchange it for a common stock of the issuer at a specified ratio. Convertibles pay lower interest rates compared to bonds, but the investor can gain more if the stock price of the company rises. In this case, the convertible bond will fare better than the conventional bond. With this in mind, the intelligent investor can easily surmise that convertibles actually offer less income and more risk compared to other types of bonds. This typically is attractive to conservative investors whose holdings are largely in bonds. Adding convertible bonds to their portfolio is a great way to diversify their portfolio without really diving into the scary world of stocks investing. The convertibles market has grown into a $200 billion market since Graham's day. They're offered in 7 to 10 year range, and most of them carry some form of call protection, where it gives assurance against early redemption. These added protections make convertibles less risky. 4 extremely instructive case histories. The 4 companies that represent extreme case histories are Penn Central Railroad Co., Ling Temco Vote Incorporated, NVF Corporation, and AAA Enterprises. Their cases are examples of neglect in various forms. They hold warnings and instructions for every individual who trades in stocks and bonds. Penn Central is an example of neglect and financial weakness. Ling Temco Vote is an example of quick and unstable empire building backed by indiscriminate bank lending. NVF Corporation is an example of a small company acquiring another company that's 7 times its size, resulting in massive debt. AAA Enterprises is an example of public stock financing based on franchising, backed by stock exchange houses, resulting in bankruptcy and price inflation within just 2 years. These are lessons in the stock market that investors and speculators should learn from to avoid huge losses in the future. There are extreme cases that no one expected, but they happened anyway because of the questionable practices of companies involved. Commentary in Chapter 17. New extreme cases have emerged since Graham's examples from 1960 to 1970. In mid-2000, Lucent Technologies became the 12th most valuable company in the U.S. and was owned by more investors than any other U.S. stock. Its stock price plummeted and the company lost about $190 billion in market value. Another example is Tyco International Limited, a company that went on a shopping spree, acquiring about 200 companies through its strategy of growth by acquisition. The company grew fast, but their expenses were so huge that they couldn't possibly operate profitably. There are more companies that joined Lucent and Tyco and lost billions of dollars because of unsound business strategies and questionable accounting practices. They were attractive to investors, but were fundamentally flawed. Comparison of 8 pairs of companies. By selecting 8 pairs of companies that appear next to each other on the stock exchange list, Graham was able to show the many varieties of stocks in the market in terms of financial structure, policies, performance, speculative tendencies, and investment attitudes. As expected, the performance of the companies differed greatly and their attractiveness to investors varied. It had to do with their size and type of business. Companies with better growth and profitability records have sold stocks with higher multipliers to their current earnings. Another interesting finding that was unearthed in the exercise was that there have been great market activities in some of these companies. With how they perform in the market, the companies are more speculative than sound investment options. Other companies, on the other hand, were worth more than their prices, but were not attractive to investors because of the shrinkage in their earnings. This goes to show that some companies don't get traction because they were judged based on just one metric. Commentary in Chapter 18. Utilizing Graham's compare and contrast technique proved useful in deciding which stocks to select and add to the portfolio. The conditions vary, so the pricing of stocks varies as well. Some of the cheap stocks may become overpriced, and expensive stocks may become cheap at some point in its life. It's important to remember that good stock prices come and go, so it's not right to say that one stock is good based on the price alone. The market derides Graham's investment principles in the short run, but are revalidated in the end. Buying stocks based purely on high pricing, shareholders, and management's dividend policy. Investors and shareholders are urged to have a more intelligent attitude towards their management. It's imperative to demand satisfying explanations when the company's results are unclear and appear to be worse than what was expected. Shareholders have the right to question consistently unsatisfactory share price for a long period of time. This is important because poor management leads to poor market prices. In general, shareholders want more generous dividends, while management prefers to keep the earnings and use them to strengthen the company's bottom line. Nowadays, companies deliberately keep down dividend payments so they can reinvest the profits in the business. The counter-argument here is that the shareholders deserve the profits in the form of dividends. After all, the profits belong to the shareholders. The dividends paid out to the shareholders are real money. If the company retains the shareholders' earnings, there's a chance that they may not show up in tangible values. It is Graham's belief that shareholders should demand a normal dividend payout. If the company opts to go the other way, it should at least prove that reinvested profits have produced an agreeable increase in per-share earnings. Commentary in Chapter 19. Corporate scandals, allegations of mismanagement, questionable accounting, and tax practices that plague huge firms like Enron, AOL, Tyco, WorldCom, and Sprint, to name just a few, is a stark reminder of Graham's call for vigilance towards management. The investor, as a business owner, has every right to hire and fire management if they behave against standards of conduct. However, in practice, shareholders are far from being business owners, and they behave in a sheep-like fashion. They vote for whatever the management recommends without exercising due diligence. When you buy a stock of a company, you practically become an owner of the company. The management works for you, and if you think they're not managing the company properly, you have the right to demand clear-cut explanations. In an extreme case, you can demand a change in management and the board of directors. Margin of safety as the central concept of investment. Margin of safety is the difference between the value of a stock and its market price. This concept is essential in the selection of bonds and preferred stocks. The ability of a company to earn in excess of their interest requirements constitutes the margin of safety. Furthermore, this protects the investor against future net loss. The function of the margin of safety is to disregard the unnecessary estimate of future numbers. Large margins mean that future earnings will not fall below the figures in the past, so it provides a bit of protection to investors against unfavorable circumstances in the future. For bonds, the margin of safety is arrived at by comparing the total value of the company against the amount of its debt. To illustrate, if the company is worth $30 million and has a debt of $10 million, then it has room for a contraction of about 2/3 in value before the bondholders will suffer losses. This cushions investors from the blow of a sudden decline in value of the company. Common and preferred stocks can also benefit from the margin of safety concept with some modifications. Investing in growth stock relies on expected earnings as opposed to past earnings used in the margin of safety. It's not a less reliable guide than the past records. So in certain cases, this can give a dependable margin of safety, even if the calculation varies. By following conservative projection, investors must err on the side of understatement. Commentary on Chapter 20. Risk could be interpreted in many ways. In the 1990s, risk didn't mean losing your money, but making less money than anticipated. It has a lot to do with comparing earnings with everyone else. If someone is earning more and quicker, it creates risks. More than that, it creates fear that the poor market performance would eventually wipe out accumulated wealth. Interestingly, those who take the biggest gamble during a bull market are the same investors who suffer the most in a bear market. Once big money is lost, there's a tendency to gamble even more just to get back the money you lost. It's an infernal cycle that magnifies the losses than the gains. The only way to be profitable in the market is not to lose. This is a tall order, since losing some money is part and parcel of investing in a volatile market. As an intelligent investor, you have the responsibility to make sure you don't lose all of your money. You must apply the concept of margin of safety and be firm in refusing to pay too much for stocks. This way, you can minimize your chances of permanent loss. Risk resides inside you. You must have the ability to calibrate your confidence so you don't overestimate your anticipated gains. And if your analysis turns out to be wrong and you lose money as a result, you must correctly anticipate your regret so it doesn't hit you so hard financially, emotionally, and mentally. Even though The Intelligent Investor was originally published in 1949, the insights, analysis, and commentaries are still applicable to this day. This is a testament to Benjamin Graham's accurate discernments and solid understanding of the behavior of the stock market and investors. This book is not only a comprehensive guide to understanding business and stock market concepts, but it is also a useful tool to help us understand how we behave as investors. It shows how vulnerable investors can be when presented with favorable information about certain stocks. Knowing the vulnerabilities and the tendencies of investors can help develop the discipline to adopt a more conservative approach to investing. Graham's value investing philosophy gives investors a framework for making sound decisions. The intention is to maximize profits and minimize risks. It helps build the discipline to keep emotions at bay before making critical investment decisions. Using the business and behavioral principles developed by Graham will not guarantee massive payouts, but it will give you a safety net so you won't fall into booby traps set by devious entities that overstate the profitability and growth of their respective companies.